It was a rocky year for the Canadian economy as Donald Trump's tariffs began to take hold. That uncertainty only intensified in January when Prime Minister Justin Trudeau announced he was stepping aside, ultimately paving the way for Mark Carney to step in.
Canada's latest employment numbers show the worst monthly job losses in the past 4 years.
This isn't just one bad month. Employment is essentially unchanged since September.
Well, since the Israeli-American air attack began, and we've seen the price of oil rise sharply, and you're reporting this morning, Tammy, that's coming up heading towards $2 a liter, largely because the military action there has caused the closure of the Strait of Hormuz. That is a key shipping route off Iran's west coast. About 20% of world oil supply coming through there. That has effectively been shut down.
We got jobs numbers out this morning showing Canada's economy losing 25,000 jobs, and yet unemployment didn't go up, it went down.
So Canada lost roughly 84,000 jobs last month, and employment ticking up to 6.7%.
Canada's economy did not suddenly get weak. It was already weaker than it looked. That is the story people are missing. Before the U.S. tariff headlines, before the job losses, before the oil shock from the Iran war, the weakness was already there, and now the mask is coming off. Late 2025 should have been the warning. Canada's economy contracted at an annualized rate of 0.6% in the fourth quarter, weaker than expected. Exports rose 1.5%, largely because of unwrought gold, but the quarter was dragged down by a huge $23. 46 billion inventory rundown and a 4.4% annualized drop in residential investment. In other words, the economy was not broad-based strong. It was softer underneath than the headline story suggested. That matters because when an economy is already fragile, the next shocks do not just hurt, they expose. And that is exactly what happened when the first big 2026 shock arrived from the South. U.S. tariffs and trade uncertainty. Canada then lost 83,900 jobs in February, and the unemployment rate rose to 6.7%. Youth unemployment hit 14.1%. Reuters tied the deterioration largely to U.S. tariffs and the uncertainty surrounding them. January and February together wiped out much of the labor market progress Canada had built late in 2025. That is not a healthy economy taking a hit. That is a weak economy revealing how little margin it had. Now look at manufacturing, because that is where a lot of hidden weakness becomes visible faster than in GDP headlines. Reuters reported that Canada's manufacturing PMI slipped to 50.0 in March, the lowest in 3 months. Output fell to 49.6. New orders dropped to 48.7. Tariffs on autos, steel, and aluminum were directly cited as weighing on exports and confidence. That is what exposure looks like in real time. Firms hesitate, orders weaken, investment slows, and the labor market starts to crack. So, the first exposure came from tariffs. Then came the second one, oil. And this is where the story gets even more dangerous because the Iran war oil shock hit a country that was already weak and made stabilization harder. The Bank of Canada held rates at 2.25% and warned that heightened uncertainty from U.S. trade policy and global geopolitical risk was clouding the outlook. Inflation was around target, but the bank said higher oil prices would push it up in the coming months. Reuters' account of the bank's decision made the point clearly. The economy is soft, but the oil shock complicates the path to relief. That is the trap. If growth is weak, you normally want easier policy. But if oil is pushing inflation back up, easier policy becomes harder. So now Canada is stuck between two pressures: tariffs hurting the real economy and war making inflation stickier. That is why this is not just another jobs down, prices up story. It is about a weak base getting exposed from both sides. And once you see it that way, everything lines up. The Q4 contraction was the first clue. Gold softened the optics, but not the structure. Tariffs exposed the weakness in jobs and manufacturing. The oil shock exposed the weakness in policy room. That is the full sequence. Now, some people will say Canada is an oil exporter, so higher oil is not all bad. That is true, but only partially. Reuters reported that January GDP rose just 0.1%, slightly above expectations, with gains from mining, quarrying, and oil and gas offsetting weakness in manufacturing. So yes, the energy side can still support parts of the economy. But that is exactly the problem. Support is narrow, while weakness is broader. An economy can get help from oil and still be too soft overall to feel stable. And that is why the gold story matters so much. Gold and oil can both help the macro picture look better than it feels on the ground. They can soften the appearance of weakness. But they do not tell you whether housing is healthy. They do not tell you whether factories are hiring. They do not tell you whether households feel secure. They do not tell you whether the central bank has room to rescue the economy. That is what makes the current moment so revealing. Because the comforting parts of the data are narrow. The pressure points are wider. And now add politics. Canada is not being squeezed mainly by domestic mistakes alone. It is inheriting external shocks. U.S. tariffs are hitting the labor market directly. The Iran war oil shock is pushing up inflation risk from outside. The Bank of Canada is left trying to manage an economy that is weakening from one side and heating up from the other. That is a bad place to be. It means even if growth slows further, rates do not automatically come down fast. It means even if unemployment rises, inflation can still limit policy flexibility. It means the old assumption that weakness will quickly bring relief becomes less reliable. That is the bigger trade economics point. The danger is not just the latest shock. The danger is that Canada may have entered 2026 with less cushion than policymakers, markets, and the public fully appreciated. And if that is true, then the next few months become much more important. Watch growth. January was only 0.1%. Watch manufacturing. Orders and output are already weakening. Watch unemployment. February's 83,900 job loss was not a small miss, and watch the Bank of Canada. It is now openly saying oil can lift inflation even while the economy faces heightened uncertainty. That is the real policy trap. Not a dramatic collapse, not a single headline crisis, but a country discovering that the economy underneath was softer than it looked, just as outside pressure got stronger. So here is the real trade economics take. Canada's problem is not that one bad thing happened. It is that late 2025 already showed a weak foundation, and 2026 has started by stripping away the cover. Q4 contraction was the warning. Gold helped hide part of it. Tariffs then hit jobs and manufacturing. The Iran war oil shock made inflation harder to contain. And the Bank of Canada now has less room to cushion a slowing economy than many people assume. That is the sequence. A weak base, then exposure, then less room to respond. And once an economy loses both momentum and policy flexibility at the same time, the issue is no longer just growth. It becomes vulnerability. So here is the closing question. Was late 2025 the warning Canada did not take seriously enough, and are tariffs plus oil just exposing an economy that was already weaker than it looked? See you in the next